Deep Dive, Sable Offshore. Part 5. The Bear Case Invert. Always invert. Okay, let's talk through this part of the Sable Offshore story like we're breaking down a high-stakes investment thesis over a call. The core idea here is that even in California's tough regulatory landscape, Sable isn't pinned to just one path. They've built in multiple ways to actually get the oil to market and start generating cash. It's a smart hedge against the binary risks, and it bumps up the probability that something works. I'll walk you through the two main monetization routes, then the option-like payoff structure, and wrap with why this setup feels so asymmetric. Multiple monetization paths. Despite all the pushback from state and local authorities, Sable has engineered a dual-track strategy. The goal is simple: get hydrocarbons sold commercially, whether through the legacy onshore pipeline or by sidestepping it entirely offshore. First, the pipeline restart path. This is the quicker, lower-cost route if it clears. The existing system runs from the platforms through subsea lines to Las Flores Canyon (LFC) processing, then onward via lines 324 and 325 to refineries farther inland. Sable has spent years repairing, testing, adding 27 emergency shutoff valves, running smart pigs for integrity checks, all under the 2015 consent decree. Early plans targeted state fire marshal approval by late 2023 and restart by mid-2024, but Santa Barbara County blocked permit transfers, November 2025, vote to deny, and other local hurdles piled up. That's when Flores pivoted hard to federal preemption. Late 2025 breakthrough, PHMSA, federal pipeline regulator, issued an emergency special permit December 22, 2025, citing the national energy emergency, tied to Trump's EO, reclassifying segments as interstate, and approving restart with enhanced measures. Then, on December 31, 2025, the Ninth Circuit denied the Enviro Group's emergency stay request, meaning no immediate injunction blocks ops while the full merits case plays out. Expedited briefs, plaintiffs January 26th, answers February 17th, interveners March 3rd. Bottom line, federal green light overrides much of the state resistance for now. If they navigate the ongoing litigation and any remaining state consistency reviews, coastal, etc., this path could deliver first commercial sales relatively soon. Oil already flows to LFC storage from offshore production restarts in 2025. The bear case starts by recognizing that Sable has more than one way to get oil to market, which lowers the risk of total failure but doesn't eliminate it. The fastest and cheapest option is restarting the existing pipeline system that moves oil from the offshore platforms through Las Flores Canyon and on to refineries. Since the 2015 spill, Sable has repaired, tested, and upgraded the system under a federal consent decree. When California regulators and local authorities blocked progress, management pivoted to federal preemption. That strategy paid off in late 2025 when PHMSA issued an emergency permit, and the Ninth Circuit declined to halt operations, allowing the restart to proceed while litigation continues. If courts don't intervene, this remains the most direct path to near-term commercial oil sales. Second, the offshore storage/tanker path, OS&T, the true backup plan to bypass California onshore entirely. This involves deploying an offshore storage and treating vessel, or similar floating facility, right at the SYU in federal waters. Oil gets processed, stored offshore, then offloaded to shuttle tankers for direct shipment to refineries, potentially outside California, opening better pricing and markets. Sable announced this alternative in late 2025, targeting vessel acquisition in Q1 2026, modifications/installation through mid/late year, and first sales in Q4 2026 at rates potentially over 50,000 barrels per day. It's more capital-intensive, vessel costs, platform mods, etc., and slower, plus needs federal approvals, interior/BEC for OCS ops, maybe air/emissions permits. But the big edge? Jurisdiction stays mostly federal. Platforms are in federal waters, California has limited say, and preemption arguments, like with PHMSA, could carry over. If onshore gets permanently blocked, this keeps the asset alive without relying on state politics. Pursuing both in parallel maximizes odds: pipeline for speed if federal momentum holds, OS&T as the out if state roadblocks drag on. The offshore storage and tanker plan is Sable's insurance policy. If California keeps blocking the onshore route, Sable can process and store oil offshore and ship it directly to refineries by tanker, largely staying in federal jurisdiction. This route takes longer and costs more because it requires a specialized vessel and platform modifications, but it avoids state politics and keeps the asset viable. By pursuing both the pipeline restart and the offshore tanker option at the same time, Sable improves its chances. The pipeline offers the fastest payoff if federal approvals hold, while the tanker route provides a workable fallback if state resistance continues. Option-like payoff, high upside versus potential zero. This isn't a gradual growth story, it's classic special sit binary, massive unlock or bust. Sable is pre-revenue, oil to storage only, no sales since 2015, burning cash while debt piles up. But the moment commercial flow starts, it flips to a high-margin producer fast. SOC's edge is the dual paths, pipeline for near-term speed, federal tailwind helps, OS&T for regulatory workaround, federal waters, tanker flexibility. They need key approvals, bridge financing/refinancing, and no major incidents to hit first sales. If they pull it off world-class tier, one asset online cash flowing, the stock can explode as shorts unwind and NAV unlocks. If not, time runs out on debt/reversion, the downside is total. That's the special situation math. Mispriced binary bet on execution and catalysts, not steady compounding. High conviction if you believe Flores threads the needle, his track record says he can, but zero tolerance for error. Classic high variance play, limited ways to win big, but one good path could be transformative. This is an all-or-nothing bet. Sable isn't slowly growing a business, it's burning cash while waiting for permission to sell oil. If commercial sales start, the company can flip quickly into a high-margin producer and the stock could jump as the asset's value becomes real. If sales don't happen in time, the debt overwhelms the company and the equity goes to zero. The upside comes from having two shots on goal, the pipeline for speed and the offshore tanker plan as a workaround, but both require approvals and financing. If management executes, the payoff can be huge. If they don't, there's no soft landing. This is Avi. Like and subscribe. On to the next.